What's going on, my fellow wealth creators? Matty Guys here. In this video, I want to answer some of the most frequently asked questions about dividend paying whole life insurance, just to help you get the answers you need, get the information you need in order to make an informed decision about whether or not something like dividend paying whole life insurance would be a good fit for you or not. We get a ton of benefits from these policies, but it's definitely not for everybody. For me personally, it was a no brainer once I understood how it actually works. Not how mainstream financial media wants me to think how it works, like how it actually works by doing my own research, getting the answers to some of these questions. It was a no brainer. And now I have two policies. It's been a game changer in my life. I absolutely love them, but they're definitely not right for everybody. So that's why I want to do this video so that you have the information you need to make an informed decision that's going to be best for you based on your specific financial situation and goals. All right. So let's have some fun. First question. Isn't whole life insurance a horrible investment? So the first thing I'm going to say here is that it's not an investment. Why are we comparing like what I would call a very efficient savings vehicle? Why are we comparing that to an investment, right? You wouldn't compare a savings account to an investment, would you? So why are we comparing whole life insurance to an investment, right? It just doesn't really make sense. Like comparing apples and tater tots, they're just not even the same thing. And the other part of that answer is that whole life insurance is called the and asset for a reason, because we don't have to choose between doing whole life insurance or investing. We can do both. I do both, right? I set up my two policies, and now I use the money in my policies use my policies to build wealth. I prefer real estate investing. I love private money lending. That's my favorite wealth building strategy right now. Talk more about that in another training. I'll link that down below if you want to learn more about it. But yeah, we don't have to choose one or the other. We can do both, right? And obviously, what you invest in is going to come down to your investor DNA and risk reward, your risk tolerance, things like that. But yeah, whole life insurance, not investment. Think of it as a very efficient savings vehicle. That's how I think of it. They make really good emergency and opportunity funds, right? We'll probably get into that a little bit more as we answer more of these questions. Let's see. Question number 2. Doesn't whole life insurance get a terrible rate of return? Okay. Well, again, what are we comparing this to? Terrible rate of return compared to what? If you're comparing it to a mutual fund, or maybe, you might get 30% in the stock market in any given year. Well, again, is that a fair comparison? And also, is it still a horrible rate of return, even though it doesn't earn 30% in the stock market, or like the stock market could in any given year? Well, no. Just like with savings accounts, like high yield savings accounts right now, I don't know, 4 or 5%, whatever, because interest rates are high. Do those get a terrible rate of return just because you can get a potentially higher rate of return in the stock market? No, because it's a different asset class, right? And again, whole life insurance, because it's a very efficient savings vehicle, we're not comparing it to like super high rates of return because it's a safe asset. It's in that safe asset class, very similar to something like a savings account, maybe bonds. It's a really good bond alternative as well. But the internal rate of return of these policies, when you custom design them correctly, because you can do that. I did it for both of my policies, and my first policy is going to net around 4% net internal rate of return, tax-free compound, uninterrupted compound growth for the life of the policy. I think that's pretty good for a savings vehicle, especially since I can borrow against my cash value, borrow against the policy, use it to build wealth like I normally would, make my investments in real estate, do my private money lending. Why on earth would I not set that up, right? Because here's how I would explain it. If your bank called you up and said there was a brand new savings account that's going to pay you 4% tax-free, uninterrupted compound growth for the rest of your life, they would allow you to use the money in the account to build wealth and make investments like you normally would without interrupting the compound growth. And it would also pay out a massive income tax-free death benefit to your loved ones if you passed away unexpectedly. Does that sound like a good savings account? No, that's pretty good. I think most people would say yes. Now, again, this is whole life insurance. It's not an actual savings account. I'm just I'm trying to group it properly. It's in a safe asset class. So we can't really expect to get these really high rates of return, just like you wouldn't expect a super high rate of return in your savings account, right? But I think 3 to 5% uninterrupted compound growth with the tax advantages. I mean, that could turn into a pretty decent amount of money over the long run. So I don't know. I'm happy with it, anyways. All right. Next question. Doesn't the life insurance company steal your cash value when you pass away? No, it does not. So this is another one of those questions. It's just kind of a silly thing that mainstream financial media will put out there. People like Dave Ramsey will say this. I've heard him say this multiple times. They steal your cash value. It's like, that's not true. Why are you saying that? It's just a lie. So a couple of different ways I like to explain this. So first off, let's talk about the technical side of it. I guess you could call it, and then I'm going to give you an analogy that should address this. All right. So with a dividend paying whole life insurance policy, you have cash value and you have your death benefit. Okay. The cash value, think of it like your equity. All right. That's what people like Dave Ramsey say that it goes away. They steal that, right? They take all your money, whatever. What they're not accounting for, again, they're only telling half the story, is all the death benefit that your beneficiaries get. Okay. So what the example I like to give is, let's say you have $1 million death benefit and $500,000 in cash value. Okay. So what would happen if you were to pass away? The life insurance company is going to look at your cash value and say, okay, he's got $500,000 in cash value, but we owe $1 million death benefit. So what we're going to do is we're going to give the beneficiary the $500,000 in cash value, and then on top of that, we're going to add another $500,000 to meet our $1 million death benefit. So there's an argument to be made that your beneficiary gets the cash value plus a little bit more to equal the death benefit. And because it's life insurance, it passes on income tax free. All right. So stealing cash value? No, they get the cash value plus more in order to equal the death benefit. Hopefully that makes sense. The analogy I like to give is a house. Okay. So let's say you have a house that's worth $300,000 and you have $150,000 in equity. Okay. Well, let's say tomorrow you sold the property for $300,000. Would you expect to get both the $300,000 that it sold for and the $150,000 of equity? Well, no, that'd be ridiculous, right? That's stupid. The bank would think you're crazy. That's not how it works. You would get the $150,000 of equity that you have. Well, it's literally the same exact concept when it comes to whole life insurance, because the cash value is the equity. You could think of the death benefit as the value of the contract or the value of the home, using that analogy. All right. You're not going to get both. You wouldn't get both in the scenario I just provided with the house. Why would you get both with the whole life insurance policy? So it's just half story, kind of silly, misleading stuff. They don't steal the cash value. You get the cash value plus more to equal the death benefit. That's how I like to describe it. Hopefully that answers that question. All right. Next question is, don't I have to pay into a whole life policy for my entire life? Absolutely not. There's a lot of flexibility with this. You could pay into a policy for 7 years, 10 years, 20 years, up till 65, 70, 75, whatever. I mean, there's a lot of flexibility. It just comes down to what you're trying to accomplish, what your goals are, what your current financial situation is. The way I like to think of these policies is like setting up my own banking system, because I can utilize the money in the policy to build wealth, make investments like I normally would. And that money is going to continue to compound uninterrupted in the policy. But because I have instant access to it, I kind of think of it as my own banking system, right? So I want to put as much money into that for as long as possible. With that said, everybody's different. So if you wanted to only put money into your policy, make premium payments for 10 years and then be done, never owe another premium payment ever again, you could absolutely do that. And your cash value and death benefit are still going to grow, even when you're not making premium payments. So just like a mortgage on a house that you can pay off and you still own the house, right? And the house will continue to go up in value, even though you've paid off the mortgage. It's the same thing with a whole life policy, guys. You can pay off a whole life policy. It will continue to grow. You'll never owe another premium payment afterwards, and you're good to go. It'll be there the rest of your life. It's awesome. It's a very, very awesome benefit of whole life insurance policies. All right, next question. Oh, this is a fun one. Isn't whole life insurance way more expensive than term insurance? Okay, well, if you're only talking about death benefit, then yes. Whole life insurance is a lot more expensive for death benefit than term. There's a reason for that. Just because something is more expensive doesn't mean it's not providing an incredible amount of value in our lives. The example I like to give, or the analogy I like to give, is the difference between buying a home and renting. Okay. Well, isn't buying a home way more expensive than renting the home? Well, yeah. You have to put a lot of money down as a down payment. You've got property taxes, insurance, maybe HOA fees, maintenance, right? You know, lots of expenses, and not to mention with the mortgage. If you do a 30-year mortgage, you're going to end up paying for the house twice because of the interest that you're going to pay. Right? You pay a ridiculous amount of interest on a mortgage. So buying a house is more expensive than renting the house. Why would anybody ever buy the house when you could just rent it instead? Well, when it's put that way, it's kind of silly, right? Well, people buy a home because there's a lot, excuse me, a lot of benefits that we get, especially long term, that you get from buying a home that you don't get when you rent a home. So, for example, when you buy a home, it's yours. You can do what you want with it, right? You can, not to mention all the memories that you create with it as well. It's an asset that you can tap into. It's going to grow in value long term. You know, you can get a home equity line of credit, use that to build wealth, right? So you're building equity in the property that you can utilize to accelerate the wealth building process in your life if you want, right? So it's something you pass on to your kids as a legacy play as well. Like there's so many benefits that you get. That's why it's worth paying. Yeah, it's going to be more expensive than renting, but you get the benefits that you get from buying the home far outweigh any savings that you would get by renting, right? So, for example, like if you rent a house, are you able to? Do you have an asset that grows in value long term? Nope. Do you have access to equity so that you can use it to build wealth? Nope. Do you own the property? Can you do what you want with it? Nope. And what happens when your lease expires? You're kicked out, right? You move on to the next place. Maybe you can renew, whatever. But I'm saying there's a lot more benefits to buying than renting. Again, depending on your situation, obviously. But the point is, when comparing it whole life to term, it's very, very similar because whole life is something that you own. It's an actual asset that's going to grow in value for the rest of your life, or at least as long as you have the policy, assuming you don't mess it up and or surrender the policy, whatever. But it's going to get that 3 to 5% tax-free, uninterrupted compound growth for the life of the policy. So it's growing in value. You have cash value or equity that you can tap into. You could borrow against your policy to build wealth, maybe cover an emergency, just like you would with a HELOC. All right. It's something you could pay off. Can you ever pay off your rent? No, you're paying rent every single month for the rest of your life if you're going to stay a renter. We just talked about this with whole life. You can pay that off, right? Just like a home, you can pay off the mortgage and still own the home. You can't do that with renting. You can't do that with term insurance. When it expires, it's gone. Okay. So, yes, for the death benefit, it's more expensive, but for all the long-term benefits that we get from these policies, for me, it's a no-brainer. Not to mention, you can add term insurance on top of a whole life policy. In fact, we normally do that to avoid mecking the policy, modified endowment contract. That's a different video, but you can add term insurance on your whole life policy to get as much death benefit as you need. But now you have this asset that's going to help you accelerate the wealth building process in your life and we get so many benefits from it. So hopefully that answers that question. All right, let's see. Next question. Don't I have to wait years to get access to my cash value? No. If you listen to mainstream financial media, what they're typically talking about when they say it's a horrible investment, you have to wait forever for it to break even, 15, 20 years. You have to wait, 3, 4, 5 years to access the money. They're talking about traditional whole life policies that are not custom designed for high cash value, because you can do exactly that, guys. You can custom design these policies to get access to the majority of your cash value within the first 30 days. That's what I did. I had access to almost 90% of my money in 30 days. I actually took my first policy loan within 2 weeks to purchase my vehicle. And then a few months later, I set up another policy and I'm able to lend out on real estate, do my private money lending now, right? But anyway, you don't have to wait years to get access to your cash value. It just comes down to how you design the policy. All right, this is a fun one. Why would I pay interest to borrow my own money? So you're not. When you borrow against your policy, you're borrowing the life insurance company's money. You're not borrowing your own money. Okay. And there's a reason that this is so powerful. Hang on one second. Getting a little dark in here. All right. The reason this is so powerful is because we're using leverage here. We're using somebody else's money to cover our emergency, make large capital purchases, hopefully build wealth. That's the ideal way of using these policies. But while we use the money, our money, the life insurance company's money, our money is still getting that uninterrupted tax-free compound growth in the policy, which is just so powerful. And the only cost of doing that is paying a little bit of simple interest on the policy loan. So again, like if we go back to the analogy about the home, I mean, people use home equity lines of credit all the time, hopefully to build wealth. But I never hear any complaining about the interest you pay on that. For whatever reason, that makes sense. But if you borrow against your whole life policy to do the same thing, all of a sudden it doesn't make sense. That doesn't make sense to me. Okay, but we're essentially doing the same thing that we would with a home equity line of credit. It just happens to be that we have a lot more benefits with these policies than a HELOC. But we're going to get that uninterrupted compound growth in our policy. We pay a little bit of simple interest for the policy loan. And if we're doing something, for example, like private money lending, where I can borrow against my policy at, let's say, 5.5%, that was the last loan rate, and then I lend it out at 12% plus points. Well, now I'm doing what the bank does, where the bank pays us, let's say, 1% on a savings account. They then lend it out at 4 to 5%, and they keep the spread. That's hundreds of percent return that they're making. So now we're able to do something very similar, where I'm borrowing the life insurance company's money. I'm using somebody else's money to make this investment over here, do my private money loan. All the while, my money's still growing in the policy. So I'm essentially earning money twice here. The only cost of doing that is a little bit of simple interest. And the last thing I'll say about it is it's absolutely worth it to pay a little bit of simple interest to continue earning uninterrupted compound interest, guys. I did a full video on this. I'll link it down below, or drop a comment if you want me to send that to you, where I show you the actual numbers, just how powerful compound interest is over simple interest. Oh my goodness. It is absolutely worth it to pay a little bit of simple interest to get the policy loan while we earn uninterrupted compound interest in our policy. It's incredible, guys. Let's see. Last question, and we'll go ahead and wrap this up. Maybe we'll do another one if you guys have other questions you want me to answer. Maybe I'll do another FAQ video. Last question, though. How do I know if a custom designed whole life policy is right for me? This is a great question. I actually just did an entire video on this. I'll link that down below. Or if you want me to send it to you, just drop a comment down below. But there's a few determining factors. I would say some of the more important ones would be like you have to be able to save money on a regular basis. If you don't have your cash flow and income fixed, then you're probably not ready for a whole life policy. You want to make sure that you're able to save money on a regular basis, because again, the way I treat these policies is like they're a very efficient savings vehicle. I'm setting up my own banking system, et cetera. And so I need to be able to consistently save money. Otherwise, I'm just putting more stress on myself, right? And I'm not going to be able to fund the policy the way I need to get the most amount of benefit. So you got to be willing or able to save money on a regular basis. I would say, if you're high income earner, entrepreneur as well, real estate investors, oh my God, this is fantastic, because you start to become your own source of capital. So if you're a business owner, I would definitely recommend looking into this more. Business owners typically need capital and funding on a regular basis. If you're able to save money and fund your own policy, you can now start to become your own source of funding. There's so many benefits to it. Again, I did a video on this specifically. If you want it, drop a comment down below. But yeah, here's the thing. Just take your time, guys. There's no rush with this stuff. Make sure you do your research, because these are major financial decisions that we're talking about here. Take your time, do your research, talk to different people, hear different sides of the story. And you're eventually going to come to the point similar to what I did, whether you're going to know whether this makes sense for you or not. It definitely made sense for me. I think these things are absolutely fantastic. But at the end of the day, it just comes down to your current financial situation. What are you trying to accomplish? If you're going to save money, do you want to save it in the most efficient way possible, or do you just want to leave it in the bank? Like, what benefits are you getting from the bank? So if you're saving money in the banks right now, it could definitely be a good fit for you. So there's a few different reasons. Make sure you check out the video, though, that I did specifically answering that question. I'll link it down below. But yeah, we'll go ahead and wrap up with that. I hope this was helpful. If you guys have other questions that I did not bring up in this video, drop them down in the comment section below. Make sure you check out all the links in the description as well. I have tons of additional tools, training, and resources about infinite banking, whole life insurance, private money lending, all this stuff, just sharing my wealth building journey. Make sure you take advantage of that stuff. So I hope you guys are crushing it. I will talk to you in the next one. To your success. Matty S is out.